So, welcome. Today I have Fahim from Foolish Investor, also founder and CEO of TIKRBUDDY. Did I say that correctly? TIKRBUDDY?
TIKRBUDDY, yeah, that's
Yeah,
correct.
yeah. It's a catchy name. I like it. So, tell us a little bit about yourself.
Yeah, so I'm Fahim. I've been from the UK. I've been running the Foolish Investor YouTube channel for a good couple of years now. Alhamdulillah, I probably started during the pandemic. And the reason I started that channel was I was just watching all this, you've probably seen it, Juan, all this terrible financial advice on YouTube
Yeah.
about I don't know, man, the craziest stocks. And I kind of wanted to do my channel to kind of bring the focus back to valuation. And that's how I started. We just focused on valuation, just trying to teach people to kind of have a look at valuation in some way, shape, or form before they were, buying into all the hype of all these stocks. So looking at stocks like this, Charge Point, and it was at like 40 times 2026 projected revenues, and I just kind of wanted people to learn, because then you can kind of weed things out, right? Once you have some rough idea of valuation and things looking excessive at certain prices.
And it was probably difficult to come out with this during that time because it was such a bull run that anybody spoke about anything. I mean, it went up 100%, 200%. So how was it? How was that a challenge for you to be the guy that's talking about, hey, let's look at the
Yeah,
numbers, let's look
I
at the
had so much.
valuation?
I had so much hate, man. If I could go back and bring up my old Charge Point, I don't buy Charge Point, don't buy Neo videos at these prices, or the hate on those videos was insane. So
Yeah.
it was a bit hard at that time, but I was glad I persevered with it. And then you kind of build that core audience, right? That knows that you might not agree with the stock picks, but at least people respected that I had gone through a process and I'd valued that stock, and at least I had a reason to believe in it. And it wasn't just, oh yeah, I think this is going to the moon. But yeah, it was tough at first. Definitely got a lot of hatred for a lot of those videos.
Yeah, and I think that's the most important thing. It's one, having a process and building your thesis based on something, based on not just hype, right? You know, a lot of stuff was there was so much hype over the last few years. We just came out of this bull market, but I'm glad that you're here. I'm glad that we have this option for evaluations. So how does your product differentiate from some of the other, I wouldn't say kind of like DCFs, but there's other scanners, I would say, like
Yeah.
pillars and all these different things. How does yours stand out?
Okay, so if we talk about the YouTube channel, I think that's what you asked me about first. And why I set that up was, you saw the slogan, no hype investing, right? And the thing with YouTube is it's very hard to succeed on YouTube if you don't have hype. So when you're trying
Absolutely.
to so YouTube kind of then became like, I don't really want to do this because I'm never really going to get my message across to people. And that's why I wanted to create this product, TIKRBUDDY, that we've created, because hopefully we can get that to people and people are using that and it's going to help them. But you were saying in terms of how it differs. So firstly, I don't think, from what I've seen in my research, and I did a lot of research on this, that I have seen anything where you could do a valuation of any stock with 4 different metrics. So whether it's unprofitable, you've got the price to sales. If it's profitable and you want to use EPS, you've got the PE option. If you prefer the EV to EBITDA like some people do, then you've got that option, and you've also got that discounted cash flow option. And I think how it differed to what some other people had going on was, a lot of people could just, I think there's an app out there where you can just plug in like, okay, I think 10, 15, 20% revenue growth and this profit margin, and then that's all there was to it. Whereas what we've done is we've incorporated analyst estimates which are sourced from Wall Street analysts, and you can see how many analysts have gone into these consensus numbers. So if you really are like an absolute beginner and you're not in a stage where, why would you think at all that you're able to kind of project if a company is going to grow 10, 15 or 20%? Kind of dangerous, really. I think if you don't have any clue whatsoever and you don't have any background in forecasting or any actual, like, most people when they start investing haven't really done anything in actually learning how to, like, I know you've studied finance, I've studied finance, so we have an idea of actually saying, okay, this suggests maybe this company might grow 10, 15, 20% a year, but most people haven't done that. And then it gets so easy to just project 50% revenue growth year on year because because you just you see something, you're like, okay, but you don't really know what you're doing. So by providing those Wall Street, I'm not saying that analysts are the best, and I don't think that that's the be all and end all, but it's kind of a good base to start from. At least you get, okay, 17 analysts have projected this much revenue, so let me kind of work off that and look at that. That's kind of a reasonable base. So we incorporate those analyst estimates, but also give you the option to use your own. So if you are someone that's a little bit more advanced, you've been doing it for a while, you feel a bit more comfortable in saying that I can project, okay, I can look at this and I do think this company should grow 10, 15% a year, then you can also use your own estimates as well.
So would you say that this is set up for someone who's a extreme beginner, no finance background, and someone who has some financial backgrounds?
Yeah, so I think because you've got both those options. So for the person who does have a financial background, it's almost like just giving you the analyst estimates to back up what you've got so you can compare the two. And also just meaning you don't have to go through an Excel spreadsheet. Everything is done on there. You just use the data points, input your own things. If you want to say 15% revenue growth, 20% gross margins, you input everything like you would on Excel without having to do it all on Excel, and it's there. And then for the complete beginner, I think it's very, very useful because when you're watching all these YouTube videos about this stock, that stock, it's going to happen again. Once the market starts to turn upwards again, you're going to obviously, again, it's just going to happen, right? You're going to get this plethora of all these, okay, look, everything's going up. This stock's going to triple this. And it just
Yeah.
means that as a complete beginner, you can just go in and just say, okay, let me have a look at, okay, this guy's saying Neo is, I should buy Neo now, but it's $100 right now. So let me just plug this in. Oh, I can see that,
Yeah.
okay, if I just put, I want a 12% return a year, and I think Neo might trade for around 15 times EBITDA, then, but wait, it looks way too expensive. And you can do that within like 15 seconds because you've got the analyst estimates and then you just plug it in through the calculator.
Yeah, yeah, I played around with it. I personally, I love it. Started using it when I did in the past, which was extremely expensive. I did like for 1 or 2 years. I was using FactSet,
Yeah.
and anybody who knows FactSet is extremely pricey.
So
But you
you
know,
can imagine it's costing a fortune to get this data on the website.
yeah, yeah. So
And that
yeah, the good thing with the FactSet is you can incorporate all their data into an Excel sheet. So they set it up for you. You know, you just tell them what you want, and you can create your DCF, put the ticker, and then it'll extract it from FactSet onto your Excel sheet. But this is a way cheaper option. So
Yes, that's kind of what it was. So I saw like people like Meek Kevin were using the Bloomberg term. I thought, look, the
yeah,
regular guy cannot fork out 25 grand a year.
right.
So let us license it for whatever price we are, and then let's redistribute it and obviously break that cost down because if we can get a certain amount of users, then it works out better for us. Yeah.
All right. So before we look at TicketBuddy, let's kind of like break down what exactly is a discounted cash flow. What is a DCF?
So I just see a simplest way to explain a DCF as figuring out the present value of all future cash flows, right? So you're figuring out how much cash is this company, if you're doing a company, if you're doing houses, how much cash is this thing going to produce? And then based on that and my discount rate, which I don't know if people disagree. I think the discount rate can become very complicated when you're trying to, oh, Bonio's this or this thing that. I found it very simple to just say this is what I want to return a year. So I want 12% a year. Like I'm looking at, okay, interest rates are this much. I know I can get probably 8% from index funds. And I want to have a higher return if I'm picking stocks because I'm taking on more risk, right? So I want at least a 12% return from an individual stock. And that's all a DCF is, just figuring out the cash flows, and based on your discount rate and the returns available to you elsewhere, what's that future cash flow worth to you today? And I guess the hardest part for retail investors is how do you project what future cash flow is going to be like when you're a complete beginner to investing? And I guess that's I guess as we'll see when we go through the app, you get all of those cash flow estimates given to you, provided from Wall Street analysts. So
Yeah, and that would be like probably the first step, right, to creating a DCF, estimating revenue, forecasting free cash flow to firm. Are you going like a 5 to 10 years or 5 years?
yeah,
What's your approach?
we've done 5 years. I know 10 years is also useful. We've done five just because I'm of the camp that the longer you project out, the less accurate
Right.
that you become, right? Even 5 years, there's so many things that could happen, but in 10 years, I mean, the amount of things that could change in 10 years is crazy. So yeah, we've gone with the 5 years approach.
And then how do you guys calculate terminal value? Like what's your
So
exit multiple approach?
We've done the Wall Street kind of method of the beta multiple. So maybe hopefully in the future we'll also implement the perpetual growth method where we'll allow that. But for now, for building the app and stuff, we've just got and that's what I use as well. I use the exit beta multiple. So do a multiple of a beta for the exit terminal value.
So maybe in the future you'll have growth in perpetuity.
Yeah.
Okay. And then how would you recommend the discount rate like for beginners?
Yeah, so this is stuff that hopefully in the website we want to have tutorials on just to make it even more simple. But like I said, I found personally obviously you give me your opinion as well, but I found that if you try to understand the complete academic side of discount rates and WACC and all of that, you're gonna really like explode your brain.
Yeah.
And I think it can be as simple as saying, look, I know I can get around 8% a year from index funds. So I want about 12% if I'm going to pick a stock because I'm taking on extra risk.
That's actually, I always put 12%. Same
Yeah,
here. I mean, I
yeah,
want at minimum 12%. If a company can yield me 12%, then
yeah.
I'm going to be happy with that.
And the only time I'll change that is if things do get really bad and interest rates start hitting 11-12%, then maybe we'll have to look at that. But at this moment in time, like, yeah, I look at index funds and interest rates, and yeah, I would just want to be a couple percentage points above the index as a base point.
And do you think you're going to incorporate any kind of like sensitivity analysis just so
I think there's like so much stuff that we want to. It's just finding a way to kind of do it on a website is just really it's really tough.
yeah,
uh,
I can imagine.
where the website still will function properly. So like even when we wanted to add different, we started with the DCF, right, and then we added the PE, PS, beta, and even that caused so many. It takes a really long time just to get it to work. But yeah, there are lots of things that hopefully whatever there's demand for, we want to add, and I think it will just take time.
Okay, so let's go ahead and take a look at the software. Okay, so as soon as someone signs up, this is what they're going to see, right? Their home, their dashboard.
Yeah, so when you've done analysis of stocks, they'll all be listed there, so you can kind of check in daily and see, okay, has it fallen below the fair value or not? But which we can show that later on once we've run a valuation.
Okay, and then just to be clear, right? You're looking at the numbers. You want to make sure you're getting this company at a good rate, but that's not the end all be all, right? We have to know the story of the product, what they're selling. Is this company building a moat for themselves, right? I mean, so
Yeah.
like there is another part of the
One,
thesis that you have to build, right?
Yeah, so I see it as either one of two ways. So I see it as you've kind of got an interest in a company, right? And you're like, let me just do this quickly and see, is it worth me spending another couple of hours before I go through the 10Ks and the 10Qs? Like, is it even anywhere? If it looks like it's already 150% overvalued, maybe you might just want to skip it, because researching and analyzing a company properly takes at least a day, maybe 2 days,
Yeah, yeah,
if not
absolutely.
longer than that. So this is kind of, you can treat it as kind of a filter, right? Like before you do your fundamental analysis, you just do a quick look and say, okay, it does roughly look like it might be okay. Let me go and do a deep dive. But yeah, definitely, I would never buy a stock without reading the 10K, without reading the latest 10Qs, without listening to all the recent earnings calls and figuring out what trend everything is going in.
Right. So let's choose a stock. And you mentioned Meet Kevin. So let's pick one of his stock, which is his favorite stock. Is he always talked about end phase. Okay, so look at one of the stocks here that is pretty popular on Meet Kevin's channel. I've heard him speak about it quite a bit.
Mm-hmm.
So we went to the homepage, we typed in end phase, and immediately the first thing that it gives us is analyst estimates, right? Up to 2026.
Yeah.
So looking at this stock, there's potential, right? It's got 29%, or it's just the number of analysts, 29 analysts
Yeah.
altogether. You're averaging 33% upside in 2023. Is that what they're saying? 20% for
Revenue
2024?
growth. That's revenue growth.
Revenue growth.
Yeah,
Right.
yeah. So if you look, that's revenue, and obviously, from the 29 analysts, you've got a consensus estimate of about $3 billion in revenue for 2023.
And we go here. Then we have the EBITDA growth, right? And
Yeah.
just explain EBITDA for us.
Yeah, so earnings before interest is depreciation, tax, amortization. Again, one of the most important things for investors to learn is the difference between earnings and cash flow, and the different things that don't equate cash flow. So obviously, companies can report a loss, right? They could be depreciating a lot of their stuff. So we lost money, but in terms of real cash, they didn't lose money, because obviously depreciation and amortization is a non-cash expense. And yeah, it's just we try to cater to different kinds of investors, and I know some people like EBITDA, some people hate it, but I mean that's your choice to make if you wanna use it or not.
And it's kind of a good way to compare apples to apples, right? Like a company can
Yeah,
have a
yeah,
different
yeah,
tax rate, right?
yeah,
So good.
yeah,
So give us
exactly.
good the EBITDA, and then why is EPS important?
So obviously that's your earnings per share. So you've got your net income, and then from your net income, that can wildly change depending on how many shares a company has. So even though you think a company's net income might double in 5 years, if their share count's going to double as well, their EPS is going to stay exactly the same, how much you get of those earnings per share. So EPS obviously very, very important. And I think generally, because of how most investors invest, many stocks generally trade at a multiple to their earnings, whether that's right or wrong or whatever. But you can assume that most stocks are going to trade at maybe 20 something, whatever relevant to them, times their earnings.
So if I was level zero, how would you and I asked you, what does EPS exactly mean? How would you
Yeah.
explain that to me?
So I would say if you have a company and your company made a profit at the end of the year, so earnings is actual profit. So after you've got your revenue, then you have your cost of goods, and then you have your operating expenses of running your business, which may be your staff, etc. Then you pay your taxes, and then you've got a certain amount of profit left. And if you own your business solely, you're going to keep 100% of your profits. So if your business profited $100, you've made $100 per share. But if you've sold shares, like many public company has, and you've got 100 shares, for example, you've got to divide that $100 profit to all those 100 shares, which obviously then gives you $1 per share in profits.
Okay. And then what does this tell the person when they see the earnings per share here growing and it's estimated to be higher? Is that like a positive sign for the
Yeah, I mean, it
base?
gives you an indication that a company is becoming more profitable. Either it's increasing its profit margins or it's growing revenue at such a rate that profits are growing that fast. But then when you get to see EPS growing faster than revenue, that's a great thing. It suggests the company is growing revenue, but also becoming more profitable. And
Yeah.
possibly it's becoming higher earnings per share because they're buying back shares. So all things that benefit investors.
Good, good. So like they're taking control. They're making more money and they're finding ways to whatever product they're make it cheaper and stuff.
Yeah, exactly. So
Okay.
one of the things I like to track is gross margin, which is also on here. I love to see the trend of gross margin. I mean, you want to see that getting higher. It just means the company is becoming more efficient at how it manufactures its product or service or whatever it's doing.
Okay. So we always hear about cash flow, how important it is because there's so many things they can do. They can reinvest in themselves, they can buy
Mhm.
back shares, they can pay down debt. Is this the shows the estimated growth of free cash flow?
Yeah, so these are the estimated cash flow numbers. So the first three numbers are the numbers that they've already posted for the last 3 years. As you can see, when you've got a little A there, 2020 A means actual.
Okay.
And then 2023 onwards is estimate. So that's kind of an important thing to get as well. So like you might think, why does 2022 say actual? But obviously different companies report. Uh, I don't know why it happens, but it happens. Some companies are already in 2023 of their fiscal year, while obviously most companies are in 2022. So if you see the little A, it means this already reported numbers, and if you see the E, it means it's estimated numbers.
Okay, good, good. So then we go down and you spoke about gross margin.
Yeah.
What's the difference between gross margin and net income?
So gross margin is kind of like right at the top, right? It's just, let's say, for example, you sell pizza.
Mhm.
So you make a pizza, how much it costs you to make that pizza, just the cost of making that pizza. So you take your revenue, what you sold the pizza for, subtract those costs, so like ingredients that people actually cook the pizza. That's your cost of making the pizza, and what you're left with is your gross margin, which is obviously before the things of opening your pizza shop, having people at the till. That's all operating expenses. They weren't involved in making your product, but they're cost of running your business.
Okay, and then net income?
Again, just yeah, as we said earlier, it's literally they call it the bottom line, right? Because the last thing. So after you've accounted for all of your costs involved in your business, including your taxes that you have to pay, what you're left with at the end is your net income.
Okay, and then we have interest expense. Why is that important to show?
I find it important to show because you kind of want to have a clue. Firstly, debt is obviously important to understand, right? Like you want to know how levered a company is, especially with the kind of times we're going in, and you want to kind of know how long is this debt going to be affecting this company for. Like, so as you can see here with the end phase, it looks like their debt's gonna, the interest expensive is still going to be fairly significant moving forward. And then that counts into your cash flow, right? Where you want to see how much that's cash that's going to have to leave the company. It's money that they could reinvest into the company if they had it. So if a company is making like 10 million in free cash flow, but then they're paying 5 million in interest expenses, it's money that's getting lost. So yeah, it's important to keep a track of.
Good. And then we have depreciation and amortization. And if you can kind of just break that down.
Yeah, so I'd say depreciation obviously easy to understand. Like you drive your car, and the more you drive it, the less valuable it becomes. The
Right.
minute I think it's the minute you leave the showroom, it's lost half of its value, right?
Yeah.
And same with businesses, they have machinery, they have lots of different things, and it loses value, and you get kind of a tax benefit for that. So when you count that as a financial loss, even though you didn't technically lose any cash, and then you write that on your thing. And amortization is pretty much the same thing, but for intangible assets. So you might have
Right.
software, you might have things like that. Obviously, we're moving more to a lot of that. So, like for example, TIKRBUDDY, I'm guessing at some point I'm going to amortize some cost of of TIKRBUDDY and of that software as time moves forward.
The trademark and stuff.
Yeah. And I
Yep.
think depreciation amortization is important to understand simply because it's a non-cash expense. It's a tricky one because, you know, some people say eventually you're going to pay it because you're going to have to replace your stuff anyway. But in that moment in time, a company might look unprofitable, but might actually have positive cash flow simply because depreciation is making them look unprofitable.
Got it. And then we have EPS gap here.
Yeah, so the first EPS number is a non-GAAP number, and then this EPS number is the GAAP number. I prefer the non-GAAP number just because GAAP has so many funny accounting rules. Like sometimes the numbers are really like skewed off from what the company's actual earnings per share are. But equally, with non-GAAP, companies can manipulate that as well to look a bit weird. But yeah, it's kind of based on your personal preference, I guess.
Okay. And then break down these last two: cash from operation, percentage of margin, and cash capital expenditures.
Yeah, so these are kind of the two core aspects of the free cash flow. If you wanted to figure out a company's free cash flow and you don't have the number, you just take the cash from operations, which is the actual cash generated from the business's operations. So you're not including things like debt and all of that kind of just what this business does as a business, how much cash does it generate. I find that really useful, especially to compare companies because they might have different
Right.
debt levels, they might have different tax level. I just want to know, like, from the thing that you do, how much cash do you generate? How profitable is your core business idea? Because your debt will go away, this will go away, that will go away, but how profitable is your business idea? So that's your cash from operations, and then your capital expenditures is the investments obviously the company has to make from that cash to reinvest into their business, whether it's property, plant, equipment, and then you get that final free cash flow number. So if a company isn't free cash flow positive yet, I find cash from operations is a very good place to kind of look at how likely they are to become free cash flow positive or how long that might take.
So we just went over the first page, and that whole first page is basically giving you the last 3 years and the estimates for revenue growth, for free cash flow growth, real useful information, all type of information that you're going to need to build your DCF, right?
Yeah, exactly. So I think to have that many data points is invaluable. Like we could have just shown you revenue and EPS, right? But this really is like, okay, let me look at gross margins, let me look at cash from operations, like where all these things are expected to go, which I think give you a much more holistic picture of where a company is. Because you could just see free cash flow estimates as being negative for 5 years, and that might be due to something like debt or something like that. But the cash from operations is actually like looking positive and growing, and the margin is getting higher. But you need to kind of see everything together to make a holistic picture, I guess.
Great. So we're going to end this video. On the next video, we're going to talk about the valuation calculators and historical financials. Please catch us on the next video. I do have a link below for TIKRBUDDY. I also have a link below for sponsor Magic Mind. Athletes have Gatorade. We use this drink here. It's all natural, 4 ingredients. It's called Creatorade, and it just helps with focus and concentration. So catch us on the next video. Thank you.